In all honesty, and with all due respect, don't get me wrong, the amount of value you are going to receive today is probably more and better than most paid mentorships. And again, after watching the full video, you can correct me if I am wrong. So our goal in this video is to teach you a market maker model trading plan without any confusion. And to have zero confusion in our overall trading, we need to be able to define things so we're on the same page. So the first thing before we even get into the market maker model is the trading plan part, as in how do we define the trading plan part. There's 5 steps to this, where the first step is a bias, second step is a narrative, third step is context, fourth step is entry, and the fifth step is our risk management. Those 5 steps create a trading plan, where whenever you have a trading plan in those 5 steps, the concepts that you are going to use are used in those steps. So concepts itself do not create a trading plan, where just having a market maker model alone is not enough to create a trading plan. Now, the market maker model fits into those 5 steps to help you with the trading plan. So hopefully that makes a little bit more sense as well, where that will allow us to then go over the market maker model fully in depth, the most value that you are likely going to see. All right, on TradingView here, we see the market maker model watch list right there. And I want to go over 4 different instruments. For the first 2 instruments right there, you see MMSM right there, stands for market maker sell model. Because of course we have a market maker sell model and we have an MMBM, which is a market maker buy model. A market maker sell model focuses overall on selling. So bearish price action that we're seeing right here, for example. Now, the first step to this market maker model trading plan is the bias. How do we determine the bias right here? We start on the monthly time frame. And on the monthly time frame, we actually see something very interesting because we see a monthly fair value gap right there, which could push price higher. So to get more clarity here, we need to go into the weekly time frame. Because when we go into the weekly time frame, we see something very, very interesting. We have a small tap into the monthly fair value gap that we saw right there. After that, this next weekly candle that we are seeing, this weekly candle is a down candle. It's not an up candle. And that also leaves behind a weekly fair value gap right there, which is quite interesting. Because if this monthly fair value gap was truly that strong, then why are we creating a weekly fair value gap? And why is this candle right there not an up candle? Which also correlates with what we saw at that time actually on the dollar. Because on the dollar right there, we were reaching for that monthly fair value gap. Where we first talked about that monthly fair value gap being a potential breakaway gap, but we never respected the weekly fair value gaps right there. To continue lower, we always continued higher. Which means if the dollar wants to continue higher right here and target a monthly fair value gap, then if we go back to Australian dollar US dollar, that means that Australian dollar US dollar can still move lower for a little bit. Why? Because it's Australian dollar US dollar, meaning when this is moving lower, we are expecting the dollar to go higher. When this is moving higher, we are expecting the dollar to continue lower. Because if the US dollar is weak, then Australian dollar is likely strong. And when Australian dollar is strong, then this pair right here, Australian dollar, US dollar, will continue higher. Where if Australian dollar is weak and US dollar is strong, like it was right there, then this is where we can expect lower prices. Everything starts off with being based on the dollar right there, on the US dollar. So knowing that the US dollar will likely continue higher for a while, that means that Australian dollar, US dollar will likely continue lower for a while. So that already creates our overall bias. And what is the bias defined again? Bias is first step direction. So we understand that Australian dollar, US dollar might continue lower for a little bit. Creates a bearish bias, a bearish direction. Then the next thing it creates is a drawn liquidity. The second part of a bias is a drawn liquidity. And the drawn liquidity is, very simply said, your target. What is the target? A target is always a PD array. So if you have a bearish direction, then you have a discount array as your drawn liquidity. Where if you have a bullish bias, which we're also going to get into later in this video, then the premium arrays will always be your drawn liquidity. So actually what we're seeing right here is that we have a very nice drawn liquidity because we first have this candle low right there. And after that, we have this swing low sitting right there as well. Why? Why am I marking those two? Well, that is where we need to understand what those PD arrays actually are. So which PD arrays am I using? First being mitigation block, then we have breaker block, then we have an order block, then we have fair value gaps. After that, we have swing highs and swing lows. After that, we have previous candle highs and previous candle lows. Where in this case, this candle low right there is a previous month's low. That in itself is a liquidity pool, because on the lower time frame, that's going to be a lot of swing lows right there, all combined, which could make it equal lows, trend line liquidity, things like that. So it's liquidity on the lower time frame. Where this swing low right there is of course also liquidity on the lower time frame, but in general it is already liquidity on the weekly time frame. I think I mentioned previous month's low right here. Of course, I mean previous week low, excuse me. So essentially that is your bias defined. Where we have the direction, bearish, drawn liquidity is a discount array. So what are we reaching for right there? Which is the previous week low and the swing low sitting right there. Now, of course, that's the first part, because now we need to go into the second step for our trading plan, which is narrative. Narrative is how are we getting there? How are we fulfilling that bias? Meaning our bias is bearish. So we are going lower. Very simply said, bearish means lower, bullish, higher. If we are going lower, then where are we going lower from? Well, how does price move? Price goes higher or lower from PD arrays, premium or discount arrays. So in this case, what is a premium array that we can go lower from? Well, that is this weekly fair value gap sitting right there. Why the weekly fair value gap? Because we also went over the monthly right there. But on the monthly, we had no close premium array sitting right here, no fair value gap, no clear order block, breaker block, mitigation block to continue lower from. To expect price to come all the way towards the closest premium array, which would have been that previous candle high or the swing high right there, to continue lower from that, that's a bit unreasonable, right? That would need a lot of volatility, a lot of movement in the market to actually fulfill that. So that is when we go down a single time frame. And again, a single time frame. Because here the weekly has a premium array to continue lower from. So when we have that weekly premium array, that is the premium array that we are going to be using. Why? The higher we go on this time frame scale in the top left right there, the stronger the PD arrays. Meaning if we have a daily fair value gap below that weekly fair value gap right there, it's likely not going to hold. Because whatever the higher time frame order flow wants to do, the lower time frame order flow is just going to submit to it. Because the weekly PD arrays, the weekly fair value gap in this case, is the strongest one that we have. So just to show you an example of what I exactly mean, if we dive into the 1 hour time frame, then 1 hour fair value gaps right here will not hold. Why not? Because those 1 hour fair value gaps are not as strong as a weekly fair value gap. And once we create this 1 hour fair value gap right there, we also actually have, once this week closes, a weekly fair value gap, which is going to be the stronger one. So we want to use always the higher time frame fair value gap right there, the highest time frame PD arrays. And that eventually will allow us to then go into the lower time frame as well. We just do this to not get fooled by price action. Now, that is the narrative, because if we are going lower, where are we going lower from? Which you may also know as the previous episode, flood. That's the first line of defense actually to continue lower. Now, then we arrive at the third step in our trading plan, which creates context. And context is an overused word, I would argue, in trading. And when I say that, I'm not pointing fingers. I just think it's a lot of confusion because people do not actually understand what it means, because people are simply not able to define concepts. When we define context right now, it's very important to understand the bias and the narrative first, because without those, you do not have context. Context is the move from PD array to PD array. It's the first PD array to the next first PD array. What do I mean by that? Well, here we had narrative. And narrative was that we are going to continue lower from this premium array, that weekly fair value gap right there. That is a premium array, right? That fair value gap. Whenever we reach that premium array, when we are going to continue lower, will be met, it will seek discount arrays. So context is the move from a premium array to discount array, or discount array to premium array. And that is always the move from premium array, in this case, to the first discount array that we will encounter. And if we have bullish context, which we're also going to go over later on, then it will be the move from the discount array to the first premium array. That creates a context area. So this low that we have, the previous week low right there, towards this high right there, this is the context area. Meaning that is the area where a market maker sell model happens on the lower time frame. And the reason why, again, this is important, because if we do not understand that, then we do not understand where a market maker model even forms. And in order to know a market maker model, we need to know where it actually forms. It does not form just everywhere random, because then, again, you might make the argument, yes, it could form everywhere random, but we're going to get completely lost if we do focus on every single market maker model that we might see in the market. So that is exactly our context area. The move from the premium array to the first discount array, PD array, PD array. Now, once we reach the premium array that we can continue lower from right there, that will allow us to go into the lower time frame right now. When we go into the lower time frame, we need to be able to align time frames, meaning that we need to be able to understand in which time frame we are actually going to go into, because are we going to go into the daily or into the 1 minute time frame? And this is also a crucial, essential part that you need to understand in your trading. And I'm going to name them right here. I have never named them actually before on YouTube, but I'm going to name them right here. Please note them down, because if you want to enter off of, for example, a sharp turn entry, which we are going to go into later, then you need to align the time frames correctly. Otherwise, everything here is futile. When you want to enter off of the monthly, you want to focus on a 4-hour entry. When you enter off of the weekly, so a weekly PD array right there, then you want to enter off of a 1-hour entry. When we look at a daily PD array, so we have daily context, then we look at a 15-minute entry. For the 4-hour, it is a 5-minute entry. For the 1 hour, it becomes a 1 minute. For the 15-minute, it also becomes the 1 minute. 5-minute and 1 minute context is something I do not use. Yes, you can go into the seconds time frame. I would not advise that. There's enough money to be made on the 1 minute and above. So off of this, we have a weekly premium, we have weekly context. That will allow us, when we do reach this weekly fair value gap, then we can go into the 1 hour time frame. But for this example right here, I want to go into the 4-hour time frame, because I want to show you how the context is within each other. There's a market maker model inside a market maker model inside a market maker model. So when we go into the 4-hour time frame right there, then we are going to use the 4-hour time frame to again go over the bias, the narrative, and the context. And we are going to create a new context area to find a lower time frame entry model. Now, in itself, the 4-hour right here could also be an entry. So if you want to swing trade, for example, then the 1 hour that we could have went into, because that would be your ideal time frame to enter on the weekly. But you can also go into the 4-hour, where the 4-hour you would need less confirmation than the 1 hour. And the reason being for that is the bigger the difference between two time frames, the more confirmation you are going to need. So for example, if we have this weekly fair value gap and I were to go into the 1 minute time frame, the more confirmation I would need in order for me to be confident and in order for the probabilities to be high that this fair value gap actually wants to push lower right there. Because imagine how many fair value gaps, 1 minute fair value gaps we might get that are not a strong entry pattern. So we need more and more and more confirmation. Where on the 4-hour and the weekly, they are not that far apart. Meaning that you only need one bearish fair value gap right here in order for you to already look to enter off of the 4-hour. Which in this case would be this entry. Now hopefully you place your stop loss above the swing high, otherwise you might have still missed a move. Or like I like to do, is target a 1 to 2, which would allow you to already be tagged out before we even come back towards our entry level right there. So where we just went over time frame alignment, I'm now going to tell you again time frame alignment. But this time frame alignment, you're going to notice that they are closer to each other, meaning that you need less confirmation, meaning you only need a sharp turn in order to enter. Where if you want to enter on a sharp turn, if it was a monthly PD array you are looking for your entry pattern on, it would be a daily ST. Weekly, 4-hour ST, daily, premium or discount array, daily context you're looking to enter off of, 1 hour ST, 4 hour 15-minute ST, 1 hour 5-minute ST. And the 15-minute stays the same because you can just use a 1-minute ST as well. So now that you know how to align the time frames, you can probably guess that when we have context, weekly context, inside of that weekly context, inside of the bigger market maker sell model that we are seeing right here, which we'll dive into in depth, then we'll also have other context. It's funny actually, because can you notice this pattern right here is the exact same pattern that we are seeing on the weekly time frame. Or if we zoom out to the weekly really quick, this right here, the down candle leaves behind a weekly value gap to continue lower off that, creates overall the weekly context. On the 4 hour right here, we see that we have the 4 hour fair value gap, down candle leaves behind the 4 hour value gap. Based on the weekly, we are still bearish. So the drawn liquidity hasn't changed right here. We've only reached the first one. After we reach the first one right there, we can look if we still want to continue lower. Then the target, the drawn liquidity, the next one is sitting right here. Is that weekly swing low. And if we are going lower, then where are we going lower from? Well, 4 hour fair value gap right there. With the first target being exact same scenario right there, right there. And then after this weekly swing low, 4 hour swing low, previous 4 hour candle low as well. So here, once we take that first low, then likely the next low is also going to go. When we take that low, then likely the next low is also going to go. So it creates this domino effect. And off of this 4 hour value gap, what can we now do? We can go into the 5-minute time frame or the 15-minute time frame. Again, that's your personal preference. So whichever one you prefer right there, you can go into. Just remember, the lower you go, the more confirmation you are going to need. So what does that confirmation actually look like? Because we arrived at the fourth step, which is our entry. Once we reach the 4 hour fair value gap right there, you can go into the 5-minute time frame like we are doing right now. And you will look for this entry pattern. But before we do that, I want to talk about the build-up. Because when we talk about a market maker sell model, you have the sell side curve of that market maker sell model, and you have the buy side curve of the market maker sell model. And the buy side curve is the move into the 4 hour value gap right there. So if I mark with the gray box, it is this move right there. Where the sell side curve is sitting right there. It's the other side. Now I need you to understand that in a usual market maker model, people would absolutely need to see an original consolidation right there at the bottom, which to us is not relevant. So whatever is to the left right there is not relevant. As you may notice, before I even got into the entry, the whole buy side curve for me right there is not relevant. It's completely irrelevant. The only thing that matters is the sell side curve in a market maker sell model. And if you do try to trade the buy side curve right there, I would also advise you just understand that that is lower probability. And the reason for that is because whenever we have low probability conditions, the market tries to take out everyone of the market. The market tries to take everyone out, meaning the market does not want anyone to be able to participate in the move. Why is that? Because that frees up liquidity overall. So then when the sell side curve here of the market maker sell model right there gets activated, that's when there's enough liquidity for institutions, big financial banks, etc., to be involved in the move lower, to be able to actually get their orders filled because there's enough liquidity freed up. And then once enough liquidity is freed up, we reach that premium rate, we have the context area, the sell side curve right there starts. You'll see it happens very quickly, extremely quick. And the reason for that is because, well, not everyone got a chance to participate right there. Some might have already blown their accounts. So whenever that liquidity is free and we don't have those market participants, the institutions, the banks, try to get involved and they don't want anyone else to participate on that move, which they do a really good job at right there, because if we did not have the patience, then we would first of all likely not even make the move because of the amount of losses we would take right there. And if we do not pay attention, then we will miss this move. The high probability condition moves always happen very fast. The low probability condition moves, like the buy side curve in a market maker sell model, always happen slow, lethargic. It will try to trick a lot of traders. consolidation, price action, all things you will see. And it's important, don't get me wrong, because that will free up liquidity. But is it truly important for us? I would argue not really. We need to pay attention to the right side of our chart. The same with a market maker buy model as well. But the last part, the absolute last part of a market maker sell model buy side curve, so this curve right here, is important. Why? Well, because the last part will have a fair value gap higher right there and will have explosive moves higher into the premium array where we are expecting lower prices from. In this case, the 4-hour value gap. And this explosive move right there will create manipulation in the form of fair value gaps. And when I say explosive move, I am referring to fair value gaps right there. We would want to see fair value gaps going into the PD array, the premium array that we see right there. Because a lot of people will be tricked into thinking price wants to continue higher right there, where we would see that fair value gap is not used as momentum, it is used as manipulation. So when we then create a new bearish fair value gap right there, that creates a sharp turn. And off of that sharp turn right there, whenever we have a move into any premium array, can be an order block, breaker block, fair value gap, whatever it may be, and we get new fair value gaps lower right there, that is exactly when we can look to get involved. Where if you were using the 15 minutes right there, you would only wait for the sharp turn. So then if this was the 15-minute chart, for example, then this would be the entry right there, covering the high to continue lower. But since we are using the 5-minute, again, 5-minute and 4-hour, there's a bigger difference between that. So we need more confirmation. We need the sharp turn and then a move away from the sharp turn. Then here is exactly the same situation where you basically use bias, narrative. Only thing that you do not use is context right here, because you do not go into a time frame below the 5-minute. Where now the narrative on the 5-minute time frame becomes your entry. So here in this leg, if we are going lower, where are we likely going to continue lower from? If we are going lower, where are we going lower from? Well, we have this first line of defense right there. So if you want to make sure to get into the trade, then that right there would be your entry, because that is the first premium array that we encounter. Then the next one is this premium array right there, but that is not the first line of defense and also not the overlapping defense based on the previous episode again. Where the first line of defense is the first premium array that we encounter, and the overlapping defense in this case would be this order block sitting right there. So if you want to enter, then you need to choose between the first line of defense and the overlapping defense right there. And don't worry, I will make the choice very easy for you as well. And as I like to do it, is I like to enter of the creation of fair value gaps. Where this right there, for that fair value gap to be created, this candle, the third candle needs to close. And when that third candle closes right there, for me, that is already a valid entry. So again, whenever I refer to, I want to see 2 fair value gaps for my entry pattern, I refer to fair value gap of the sharp turn. Then this is not the second fair value gap for me. No, once we have a retracement into a premium array, we have a new fair value gap lower, that is the second fair value gap. And that is the fair value gap that I can look to enter off of. And then using the flood, the overlapping defense, or the creation of the fair value gap, that's how you can enter. But then we have a choice. And when we create a trading plan, we do not want to have a choice. Meaning we just simply want to follow guidelines because our emotions are quite high and we do not want to make a mistake. And when our emotions are involved, then the risk of making a mistake is simply set higher. So in order to avoid making a mistake, we need to already know what we are going to do before we even dive into the chart. That's your trading plan. So here we are going to enter of the creation of the fair value gap, the flood, the first line of defense, or the overlapping defense. And I need you to understand, you need to decide that before you even get into the chart. And unless you're more experienced, then you can eventually play around with it. And which one do you decide? Well, that's quite a simple answer, to be honest. Because if you want to enter off of the flood right there, then there are pros and cons to that. Your stop loss is always going to be above a swing high in the most recent leg. And the most recent leg, again, being from that swing high towards that swing low right there, with a fair value gap in the leg. That's important. And if you want to enter off the first line of defense, so it's likely also going to be the lowest entry point, it can lead to an entry that you will not miss the trade. As in, you are likely always going to be a part of the move. But always being a part of the move is, of course, not always beneficial, because when you're always a part of the move, you might also get some extra losses. So the next step in our trading plan, and the last step, is risk management. So risk management right here in a market maker sell model, if we enter off the first line of defense, is going to be more difficult. Yes, in hindsight here, it's a great entry, but it might just retrace until we come into the overlapping defense to then continue lower, which would mean that we have more drawdown, which would also mean when we experience more drawdown, it is more difficult for us to go break even. Why? Because we want to go break even when price has no reason to return to our entry level. This right here is our entry level. And when we have this entry, we create this 5-minute fair value gap right there, which is the first premium rate that we encounter. Once we come into that, we create a new 5-minute fair value gap going lower as well, creating this swing high. And this swing high is currently the last line of defense right there. Meaning if price were to retrace, then it has no reason to come back above the last line of defense and to run that high to continue higher, because it should respect those highs to continue lower off of. Every swing high that creates a fair value gap going lower, a bearish fair value gap, should be respected right there. That creates also another entry opportunity right there in your market maker sell model. And when we have those new opportunities, whenever the stop loss of those new opportunities are eventually below the original entry that we had, then there's no reason for price to return anymore. Meaning, when there's no reason for price to return anymore, we can allow ourselves to be break even. But again, if this did not have a sting into that fair value gap to continue lower, and it had a bigger retracement in the form of this into the overlapping defense to continue lower from that, then that would have not been that easy to go break even. Where then likely the most accurate entry would have been on the overlapping defense. So if you were to enter off the overlapping defense, currently you would have missed a move. Meaning that the pros right here for the overlapping defense is that you likely always have at least a more accurate entry than the first line of defense. But the con right there is that you might miss the move on the overlapping defense. Where the first line of defense is a con, that the risk management is likely going to be more difficult most of the time. But the pro is you will always be a part of the move, most likely. So the question from me to you is, you are going to enter off the first line of defense or the overlapping defense, depending on if you like to manage your risk. So let's say you take entries and you have a job next to it, then you likely don't have a lot of time to manage that trade. So if you don't have a lot of time to manage the trade whilst you're in it, I would always advise to enter off of the overlapping defense right there. And the same goes if you are not good at risk management or you simply don't like it, then I would also advise enter off the overlapping defense because you are less exposed to risk management. If you don't mind and you just want to be a part of the move, then my advice would be the first line of defense right there. So this again is purely your personal preference, and that's where you need to make a choice. What aligns with your personality, with your time schedule as well. And the third method I mentioned was entering on the creation of the fair value gap, sitting right there. This is the same exact thing. The entering off of the creation of the fair value gap will also allow you to always be a part of the move, but the risk management is going to be more difficult. Because right here, I am entering not on an exact premium rate, which means that there's still, until we create that new fair value gap lower and until we created this new swing high right there, there was always a reason for price to actually return like this to then continue lower, which then the risk management would overall be more difficult. The deeper the retracement into your drawdown area, the more difficult it is going to be to actually manage your risk more actively, because there's always going to be a reason for price to constantly return. For example, if we were to enter right there of the sharp turn, then right here, there's still a reason for price to return because we have this order block sitting right there as well with the fair value gap before we can actually continue lower. So there's a longer period of time that price can still return right there. After that, it becomes quite easy because let's say we enter off the first line of defense, cover the high, we target a 1 to 2 within the context that we have. And the last bit of context that we have is this swing low sitting right there. And the reason being for that, I actually tweeted it out recently. The reason you want to target a 1 to 2 within the context, and we now understand what context is because that will allow you to play the rejection. The 4-hour fair value gap that we had right there, that we originally entered off of, does not even need to follow through right here in order for us to take profit. So we are only playing the rejection actually, which of course, the further we expect price to go, the lower we expect price to go and the lower our take profit, the lower probability it is going to be that our take profit will actually be hit. Why is that? Well, the higher RR that we actually target, the lower our win rate is going to be. And likely, the higher your win rate is going to be, the lower RR someone usually targets. So right here, if we target a 1 to 2 within the context, that is the highest probability thing to do. To have the RR, so your overall return, and your win rate in balance. Because here, price is only, and our entry is only reliant on the 4-hour fair value gap giving a rejection. That's the only thing. It does not need to follow through. It does not need to create a 4-hour fair value gap going lower. We only need a rejection. And that, of course, is the highest probability thing for price to do. Because of any PD array, it might give a rejection, which on the lower time frame can, of course, be an entry for us. Now, after we have this, we need to go over one more thing right here. And we need to go over the silver bullet and how the silver bullet works in correlation with order flow. And order flow is a huge concept that I go over in the money making team in my mentorship actually. And I want to briefly touch on it here. Now, the silver bullet is also sort of a hype in the trading industry. It is known as a great entry in the trading industry. And usually it also is correlated to a specific time of the day, which to me is the most irrelevant thing about the silver bullet. There's no magical time that you need for silver bullet. You need price action. And what I mean by that is, let's look at this. In the build-up right there, of course, price action was not that nice here in the build-up, meaning the buy side right there, the buy side curve of the market maker sell model. Price action was not that great, but we can say it was bullish. It was moving higher. So that means that overall bullish order flow was established. Discount arrays were being respected. So right here, once we come into this 4-hour value gap, what is the first discount array that price will encounter? It's this 5-minute fair value gap. Now price has always been bullish right here. So this 5-minute fair value gap, that first discount array that we encounter, is actually the first resistance that we encounter because we have been bullish. So initially that discount array should push price higher again, which we can see it tries to, but it fails to create a fair value gap higher right there, which to us indicates that there's a lack of momentum. And then after that, we do reach the high, but we start pushing lower with a fair value gap going lower. Once we have this fair value gap going lower right there, this is, again, on the 5-minute, not a good entry. Why? Because on the 5-minute, we never had premium arrays being respected, where all we have seen is discount arrays being respected currently, and we are only seeing the first signs of disrespect right there. Meaning, we are, as I like to call it, the transition of order flow. We are witnessing the transition of order flow. And the transition of order flow is bullish price action is slowly handing over the dominance to bearish price action, where now bearish price action, bearish premium arrays are starting to take control of price action. And the way we know that is, again, simply by our entry pattern. When we have that sharp turn and we create a new fair value gap lower right there, new lag lower, that is exactly when premium arrays are now in control. Because premium arrays have currently been respecting price right there. It was the first sign of respect right there, where the transition of order flow has now been established. So after this first resistance level right there has been traded into, we had our resistance, we had our rejection right there, we had our entry even, then the lower we move and the lower we go, the less resistance we will come into. And the resistance right here is defined as discount arrays in a market maker sell model. Again, the resistance that we saw right there was a discount array, that fair value gap right there. And once we continue lower and continue lower, then eventually you will see that here below this low, we have nothing else but swing lows. There are no fair value gaps. There are no clear order blocks to potentially get a rejection even after this has been reached right there. We only have candles and swing lows. That's it. So after we have no fair value gaps left, no order blocks left, no mitigation blocks left, and no breaker blocks left as a general rule of thumb, and we only have swing lows right there to target, that is when silver bullets start to happen. For example, this right here is a silver bullet. And a silver bullet is when we have no resistance left, because that is when the fast price action happens, simply because there is nothing to reject off of anymore. And a silver bullet is generally known as a fast entry, a sting into a fair value gap or order block, whatever it may be, and then a fast movement away, exactly like we're seeing right there. And then we have fair value gaps right there, which could create another silver bullet. Only thing here is that it becomes more difficult to place your stop loss. You don't really have a clear swing low. Last one is sitting right there. So then the 1 to 2 right here is far below your context low, meaning that that requires very high probability conditions, because now you are requiring price to actually follow through off of this 4-hour value gap all the way towards that low right there. Where we could sweep this low, we are not even sure if we want to run the liquidity or if we want to sweep the liquidity. So this is lower probability right there. Past currently, of course. Right there, it did play out. We just need to understand the different stages of probability. That's important. This is exactly how you create a market maker model trading plan. But we're not done yet, because we have not gone over the market maker buy model. And I also want to go over live conditions right here. Now, we already have a great understanding right now about the steps we want to take and how a market maker model should look like, etc. So now it's time to drill it down, because with all the information, with the crazy amount, and I promise you, with the crazy amount of value that we had in that first section on Australian dollar, US dollar, you likely also missed a few things. And it's not a shame, don't get me wrong, because it's just a load of information. So we need to go over it again and again and again. So we make sure that you pick up everything. Right here, first step, bias. We have been continuing lower right here on crude oil, and we have created a sharp turn actually continuing lower right there. And this fair value gap is something we can trade into to then continue lower off of that, where it initially was a breakaway gap again, but the weekly fair value gaps told us that we did want to trade into the monthly fair value gap instead to continue lower off of that. All discussed as well in Sunday weekly forecasts. Now this right here is where we can then look to target as well these lows, because those are our draw on liquidity. And this creates our context right now, right? From the premium array towards the first discount array. And again, you also notice I also mark out the swing low a lot of times, because usually when we reach that previous candle low right there or previous candle high, we are also going to reach for the swing high, swing low that is located right there. Then in that context area, we can now look for our entries. Now we can go into the 4-hour time frame, but before that, I want to also go into the daily right here. And in the daily time frame, we see that when we come out of this monthly fair value gap, the first discount array we encounter is this daily fair value gap right there. This is the first resistance area. So we need to understand that there is a transition of order flow happening. We have, again, the buy side of the curve, the market maker sell model, not beautiful, but we have been bullish. So discount arrays have been respected. So right there, the transition needs to happen. It can't just all of a sudden disrespect everything. And if it starts to disrespect everything, I would call that even more suspicious, because in this case, then I would think that we might actually want to continue higher instead. So right here, we have a clear transition happening. And on the 4-hour, that looks something like this, where we have the daily fair value gap, and we have the 4-hour fair value gap, and we have the monthly fair value gap. This price action is extremely low probability to trade right there, if you want to go into the lower time frame, etc. On the 4-hour, we see that we have the sharp turn. We create a new fair value gap on the 4-hour. So on the 4-hour, this actually is already the entry right there on the 4-hour. Continuing lower towards the 1 to 2 right there. But if you were to dive into the lower time frame of the 4-hour, into the 5 minutes, for example, then we would want to wait here until this daily fair value gap is overtaken, meaning we have a body closure below the daily fair value gap right there. Ideally, fair value gaps going below that daily fair value gap. that signals the transition of order flow being completed. Then if we go back into that daily time frame right here, on the daily time frame, we have now created a daily fair value gap right there. And we also have a daily fair value gap sitting right there. So there's two daily fair value gaps. Now, here, if we are going lower, where are we going lower from? What is the first line of defense? It is this daily fair value gap. So if we are going to continue lower, then this is the one I would want to be using initially. That is exactly where we also create new context, because when we come into that, what can we see? We can continue lower off of that right there, creating context in the form of this previous day low candle. After that, we have this monthly previous month's low, and we have this monthly swing low right there as well. So in here, if we reach that, and again, it might not play out at all, right? But I want to get your mind ready to start noticing those context areas. Then the next part here is where we now need to understand 15-minute entries, which currently I can't go over yet. If by Sunday we have reached the daily value gap, or we have at least done something, then we can of course go over it in a weekly forecast as well. Then right there, once we reach that daily value gap, you would want to go into the 15-minute to look for the same thing. Sharp turn, premium ray, boom, that leg right there is where you want to enter, continuing lower towards those lows. And eventually towards newer and new lows right there. So this is a market maker sell model, a live example actually, of a market maker sell model on the daily right there. But inside the daily, you have a 15-minute market maker sell model that could be setting up right there as well. So after we are done talking about the market maker buy model and you want to study something, then feel free to study this right here. Could be very interesting. No need to live trade it currently, just paper trade or tape read. Just read the price action, see what we are going to do potentially. Then now we have arrived at our market maker buy model right there. If we go into GBP Australian dollar, then all we need to do right now is inverse it. Inverse the price action. Because here we have this weekly fair value gap sitting right there. We've been going higher. We actually created a sharp turn actually already at the bottom right there. And when we come into that weekly value gap, we can look to continue higher towards the previous week high candle and this swing high right there. That is our context area. Then off of that, we can go into the daily, Then off of that, we can go into the 1 hour time frame right now to look for a potential entry. Where we have, again, now it is turned around. Why? Because we now have the sell side curve right there is the low probability curve of the market maker buy model. And we can also see the buy side curve right there is the high probability curve of this market maker buy model. And you can probably see on every example that we had thus far, how long the price action took for it to come into the weekly value gap and how fast it happens to then complete the right curve right there and the right side of our chart. This took 12 days and 7 hours. This right here took what? This, I didn't mark it correctly, but 1 day, 23 hours. Well, it's far below it. Let's actually mark it correctly. It is 2 days and 5 hours right there before we actually completed this move higher. And in the mentorship, I always like to mention a phenomenon. You are going to be waiting more than you are going to be executing more. And that is linked to also what we always say is, it always feels like in price in the market, there is more low probability conditions happening than high probability conditions. And that's true because high probability conditions happen very fast and that's with intention. Why is that? They don't want you to be a part of that move. That's why they try to take you out all this time. If you do not have patience, then you are going to be screwed. You are going to pay for it if you do not have patience. And if you do have patience, then that patience pays. Because right there, if you do not miss the move, then here you can execute on it and make that profit very quick. Now, eventually what we're seeing is not the most beautiful sharp turn right there, but we're getting fair value gaps higher right there. Perfect. Eventually we get new fair value gaps higher right there. Could be an entry as well. So this right here is actually the entry on the 1 hour right there, which you would cover these swing lows to target the 1 to 2 sitting right there. But I do not necessarily want to go over this entry because after that we have this specific entry. And Ario, why do you pick that exact entry right there? Because It feels to me like you're cherry picking, right? And I can fully understand that. So allow me to explain as well. It's time. Where currently we are going over price, we need to go over time as well. On Australian dollar, US dollar, for example, you might say, or you might think, or maybe I'm assuming it wrong, why did you go over that exact 4-hour fair value gap right there? Why did you not go over this 4-hour fair value gap sitting right there? Same fair value gap, right? Yes, correct. You're completely correct. The only thing is that it's time. Where right here on those 2 up candles right there on that day, on that Wednesday, we had FOMC. And that's not where you want to execute. You want to execute after it. And after FOMC right there, that is when we create the 4-hour value gap. We had a small time window during Asia, and you can execute during Asia because we had news supporting the ID and we had time as well supporting the ID, which is all things we're going to go over in later episodes as well. And that is exactly when we can execute. So the differentiator here between this fair value gap and that fair value gap was simply said time, where we need price and time to both agree. Again, all things we are going to go over in next few episodes as well. So don't worry, all things that we're going to clear up. So going back into the 1 hour right there, that 1 hour fair value gap right there with the overlapping mitigation block actually can allow us right now to go into the 1 minute time frame with the context right here still being intact. So the next swing high still intact, whilst we took the first context target right there. Where on the 1 hour, of course, 1 hour context, 1 hour target right there, and the candle below it. I'm not going to mark it to not mess up with the lines everywhere. So that high sitting right there is our context high. In other words, our target. All right, once we come into this 1 hour fair value gap sitting right there, we eventually create the sharp turn, a little bit below the 1 hour fair value gap actually. We then continue higher and we come back into discount raise to create new fair value gaps higher. It's exactly what we would want to see. Right there is our potential entry if we enter off the first line of defense, covering the swing low, targeting the 1 to 2, which is nicely located actually inside the 1 hour context. And this creates a domino effect. Because right here, if you were to target higher right now and you would want to target this next high, that's possible. That creates eventually a 1 to 6.82. Again, this is in rare scenarios, right? But you need to understand here that the way you would want to approach this is that at a 1 to 2, you want to take 80% off. So 80% of your position needs to be off. At least that would be my advice. Then 20% of your original position is what you can leave running towards the next target right there. You can experiment with that. You can see what you would rather do. Do you always want to take 80% off at 2R and then leave the rest running? Or do you always want to take everything off at 2R? Completely up to you. Me personally, if you want to know about my personal preference, then I like to take everything off at 1 to 2RR. So this would have been a nice 1 minute entry, where the next entry was actually this one right there on the 1 minute, covering the swing low right there, targeting again a 1 to 2. We're on the 5 minute right here. It really depends, because ideally you want to get your entry right here before we actually reach that context high, the context target right there. So if you were to enter off the creation of the fair value gap, you would have gotten involved. Which also would mean that you get involved before we even get a market structure shift or even get close to a market structure shift. Which is exactly why I only talk about fair value gaps, not market structure shifts, because simply said, you don't need them. You only need fair value gaps right there to tell you what price is doing. The sharp turn right there, entering off the fair value gap creation itself, could be an entry. If you were to enter off the first line of defense, it would be after we reach the context high actually, which makes it a little bit lower probability overall. It's what we need to understand. And then you could target the next highs right there as well. And of course, just simply your 1 to 2. Right here, we are on Bitcoin and we actually reached this target right there, which we had. And after we reached that target, we actually mentioned as well in forecast that we can look to target this weekly fair value gap. This weekly fair value gap is actually what we can also continue higher off of. First target being, once we come into that, this high right there. After that, it's this swing high. So if we actually go into the daily time frame, then right there we already created a daily ST right here, where we can beautifully see again the transition of order flow on Bitcoin, on crypto even right here. Coming into that, we try to push lower, we failed to do so, create an explosive move higher, leaving behind a fair value gap, which in itself, because of course that in itself is already an entry, but the entry itself also can be taken off the breaker right there. Because when we have a breaker and we have a fair value gap below the breaker, because this first line of defense is above that fair value gap right there, does not mean that we will always trade back into it. So then the entry and the first line of defense is that breaker right there, covering the swing low and potentially targeting higher as well. But what we can also do is go into the 4 hour, of course, and can even go into the 1 hour for our original entry pattern. On the 4 hour, it would still be a 4 hour ST entry, a sharp turn entry, which is quite late right here, not the most beautiful price action. You can see the transition of order flow, where eventually the first fair value gaps that we have sitting right there, eventually right there as well. The first context target being this. And on the 1 hour, it becomes a little bit more clear even. On the 1 hour right here, and notice how I am simply paying the most attention to the right side of my chart. Left side, the way we come into it, is not super relevant. We already know the targets based on the context area that we had. So right here on the 1 hour, we have our 1 hour ST, very, very low right there. We had one earlier, but never created a new fair value gap higher, which is the most important part, of course, because we combine the time frames correctly. We have the transition of order flow actually seen right there. And then afterwards, once we come into this breaker, we create a new leg higher with new fair value gaps higher, which you choose it. Do you want to enter off the overlapping defense, first line of defense? Do you want to enter off the creation of the fair value gap itself, which could have also been this entry right here? Let's assume again that, just to keep it consistent, that we entered off the first line of defense, then a 1 to 2 inside the context was very, very nicely achieved actually. And if we want to take profit at the 1 to 2, take 80% off, leave 20% running right there, then we could have also reached that target right there, the first context high, which is the highest probability. And afterwards, potentially, if Bitcoin still wants to continue higher and create new fair value gaps higher, then we can look to reach this high right there, which currently we still have to see because we also do not have clear context anymore right there. The further we move away from the original context area, the more fair value gaps we are going to create, the less clear context we are going to have. So here I would want to see new fair value gaps going higher on the daily time frame to get more clear context again to enter off of. This is A to Z market maker models. So hopefully I made my promise come true as well, and I stuck to my promise because hopefully you found some value in this. If you found this valuable, then I have no doubt in my mind that you will find the mentorship valuable as well. So again, feel free to do so because the YouTube here is enough to become profitable. Believe me, otherwise I would not be making this stuff. So don't feel forced to need to join the mentorship. But if you do want to, then feel free to check out the website, of course, ario.io. And we actually have a 4-month spring enrollment coming up. So you can see there's a 4-month boot camp right there, which starts the 1st of March. And then, of course, I want to thank you for your time. All right, perfect.